Now let's solve CITN question 1, October 2022. So this question is on oil and gas taxation. So here now we have Entails Petroleum Nigeria Limited. So now we're told that Entails Petroleum Nigeria Limited is an oil producing company. Let's start from the books of the company for the accounting period 1st January to 31st December 2020 are as follows. So here now we're told that the company produced 5,000 barrels of crude oil per day during 2020, and 2020 year is a leap year. So how many days are in a leap year? So 366 days are in a leap year. So after that, now we're now told that 90% was exported, while 10% are local sales. So the selling price for local sales is what? 40 naira per barrel. So in this case now told that the posted price of the crude oil at the standard API gravity of 350 was $22 per barrel. So, but the crude oil, told us that it had been agreed that for every degree increase or decrease in the API, the posted price will be adjusted by 0.05. So here the crude oil produced had API gravity of 32. The standard is 35 degree. So now, for the actual crude oil produced had API of 32. So we are going to adjust it. We are going to calculate the adjusted posted price. So here we have the incidental income from petroleum operations. So this is the value. Then we have the rate of exchange. We've noted all this information. What are the requirements? So we have A, adjusted profit, accessible profit, and the like. So, but all we now have is this. So we'll bring in the name of the company, Entails Petroleum Nigeria Limited. Then the requirement, we have to what? Compute. So we'll say computation of petroleum profit tax for the period. So which was the period now? They said the period is from 1st January to 31st December 2020. So put it there for the period 1st January to 31st December. So now we have our naira sign. So we will now first of all calculate the crude oil, the value of crude oil sold. So start value of crude oil sold. So the crude oil now is now divided into two. The first thing we have the export. So we have the sale from export, or let me call it export sales. So here we have export sales. Then the next here we have the local sales. So local sales now, that's quite straightforward. So they are told that 10% of these 5,000 barrels are being sold locally. So and they are sold at 40 naira per barrel. So 10% times 5,000 barrels times 40 is how much? And don't forget, this 5,000 barrels it's per day. So multiply by 366 days. That's for the year. So how much is that? So you can mute your mic. So this is 7,320,000. Then the export sales will now do that in workings 1. We'll come to our workings. So workings 1 now, export sales. To calculate the export sales, we first of all need to ascertain the adjusted posted price. This is, remember, the standard is what? Is 35, and at 35, the posted price is $22. So, but the actual gravity is what? 32. So we need to adjust it. So, and they said that what? For every degree, it will reduce by what? 0.05. So in that regard now, we will now say $22 minus. Now, how many degree did it reduce to? It reduced from 35 degree to 32 degree. So it's reduced by what? 3 degree. So we now have 35 minus 32 degree. Then times 0.05. That's how much? So this will be 21.85. So now since this 21.85 now, we now use to ascertain the export sales. So yeah, export sales will now be, so this will be 21.85 times the exchange rate. The exchange rate here is 100. So times 100 times, yeah, now to that 90% were exported. So we now multiply this by 90% of 5,000 barrels. So that's how much. Remember to unmute your mic. So this now we multiply times, so here now this is the 5,000 is per day. So multiply this by 366 days. So that's how much. This is 3,095,695,000. So we're going to do incidental income. Incidental income, that's 2,970,100. So we sum up to less allowable expenses. So now we now start. Production expenses, is that allowable or disallowable? Can you unmute your mic? Production expenses, allowable. So after that, we now have administrative expenses. So we also check, is there any additional information attached? So here they said that what?
Not really.
Expenses relating to the transportation of crude oil included in admin expenses is 2,350,000. So we exclude it. For admin expenses, this is 382,850,000, then minus the transportation, which is 2,350,000. So how much is it? Right. So this is 380,500,000. After that, now we now have the cost of drilling 4 appraisal wells. So here now, two is allowable.
Yes, sir.
Two out of the 4 is allowable. So now have it cost of drilling. That will be 2/4 of 85 million. So this is 42.5 million. After that, we have bad debt written off. This is 18 million. Is allowable. After that, we have allowance for doubtful debt. So this allowance for doubtful debt is not allowable. But
yes,
yeah, it's not allowable. It's not allowable. So here we have the non-productive rent. The non-productive rent. This is allowable. So there are some situations where we would have to rent some of the equipment we use. So here now it refers to the amount of royalties under an oil prospecting license. Together, okay. That is here now. In the case whereby there is a provision to deduct the amounts that will generate from the royalties under the oil prospecting license. You get that? So here now such rent won't deduct it. Here now in the notice says that it's the amount of any rent for which there is provision for its deduction from the amount of any royalties under an oil prospecting license or oil mining lease. And to the extent that such rent is not so deducted, non-productive rent, that's 16 million. After that, we have royalty on export sales. Royalty on export sales, this is allowed. The amount is 179,935,000. Also have royalty on local sales, so this is also allowed. So this is 366,000. After that, we have depreciation. So depreciation is not allowed. Then after that, we have custom duties. So here, custom duties is allowed. That's 192,000. After that, now there's this one particular thing that we need to allow. What's that? Tertiary education tax, Province 2. So number 2, tertiary education tax. So that's 2/102 times the total revenue of 3 billion minus the total expenses. So yeah, we total all this together. We have 1,163,093,000. So
093.
two over 102 times the difference between these two is zero. So this 1,163 is the addition of these items that I highlighted here. The 2 over 102 will multiply the difference between the total revenue and this total allowable expenses. How much do we have? So to ascertain the, don't forget, we also deduct the loss, too before you can get this tertiary education tax. So you deduct the unrelieved loss brought forward, and the total unrelieved loss brought forward now, you add up all this together. Unrelieved loss brought forward, so that's 14.1 million plus 18.5 plus 14.3 plus 11.8 plus 17.4. So addition of all these what? So this is 76.1 million. So we will now deduct 76.1 million. So this amount now, this is 46,466,512. So we now bring the value up. So with that, we can now sum up the allowable expenses. This is the allowable expenses. So with that now, we can now calculate our adjusted profit. So the difference between the total revenue and this total allowable expenses is the adjusted profit. So here we've calculated, we've done what we asked to do in the A. The B is now saying that we should do the associable profit. So here, adjusted profit less unrelieved loss brought forward. So less unrelieved loss brought forward, and unrelieved loss brought forward, we've already done it earlier. 76.1 million. So adjusted profit minus unrelieved loss brought forward now give us accessible profit, and that's this 2,323,325,588. So we've done A and B. Now let's go to the C. So the PI. So here now we now go ahead and say less the capital allowance. So what we have to do is petroleum investment allowance. So now this petroleum, so then now with less capital allowance, it should be lower of figure 1, lower of the addition of petroleum investment allowance, which is PIA, plus annual allowance. So now let's calculate that. So the PIA now is lower of the PIA plus annual allowance, or 85% of accessible profit. So whichever is lower. After I've now gotten that, then we now deduct to less 170% of our PIA. Let's calculate the PIA for 3. So we use the information of this qualifying capital expenditure. So the current year is 2020, so we now this year. So claim PIA on this year we acquired in 2020. So we use the information of this qualifying capital expenditure. So the current year is 2020, so we now this year. So claim PIA on this year we acquired in 2020. So here we now have the QCE as percentage of our PIA. So after that, we proceed. So here we have up to 100 meter. This is 15 million. Then the next, which is 100 to 200 meter. This is 20 million. Move 200 meter, this is 10 million. This is 10%. 100 to 200, 15%, and above 200, that's 20%. So you will now do this times this to have all that. So that will now sum up. So we have 6.5 million. So we bring it in. This is 6.5 million. What is 3 plus the annual allowance? So we have 6.5 million. So the annual allowance now check. So this is the information of QC. We'll add it year by year. We'll add it according to the year. So 7 million plus 9 million, that's 16 million. So 2016 we have 25 million. 2018 we have 19 million. That's 14 plus 5. We have 45 million. So after that now, we'll bring in our heading to workings for annual allowance. So we have our QC, have our annual allowance in percentage, and the annual allowance in value. So our QC for 2014 now. Here they don't tell us they didn't tell us the annual allowance rate, so we are supposed to know that one. Our first one is 20%. So 2014 now, we acquired those QC in 2014.
Yeah.
So 2014 up to 2020, that's how many years? In this case now, the QC we acquired in 2014 now, in 2020 now, would be how many years since we acquired it? Like, from you now start counting. So here now we start claiming annual allowance on it from
2015 to 2020.
So in this case now, the one we acquired in 2014 now, it should have expired, because here now the current year, that will be the 6th year. That's year 2020. So here now we just have it 16 million. So the one we acquired in 2016 now, the current year it should be, so here we have 2016, 17, 18, 19, 20. So 20 will be the last year, the 5th year. So this is 25 million. So and this is the 5th year. So the annual allowance for the 5th year, that's 19%, and the annual allowance in there, that's what 19% of 25 million, that's what 4,750,000. But in 2018 we have QC of 19 million. So 2018 up to date is how many years? So yeah, this is the 3rd year. In the 3rd year, the annual allowance is 20%. So our annual allowance in there, that's 3.8 million. Then in 2020 now, the QC is what? It's 45 million. Then the year now, this is the 1st year. The 1st year, the annual allowance is 20%. The annual allowance now, that's 9 million. So now this is 17,550,000. So that's our annual allowance. Come up here. 3 plus 17,550,000. That's workings for 17,550,000 plus 6.5 million. That's how much? So this is 24,050,000. So you have 85% of the accessible profit now. That's 85% of accessible profit, which is this. 5% of the amount is how much? So this is 5% of 2,323,325,588. That's 1,974,826,750. So the lower of the two now, this is 24 million. So we'll extend it. Then less 170% of PI. So now be 170% of PI, which is 6.5 million. That's how much? 11,050,000. So after that now, in lieu of this addition of these two guys, then or 85% of accessible profit less 170% of PI. So this would be minus 11,050,000. So the difference, yes. So we now take, so the difference here now, we will now compare this 1,963,776,750, and this guy, this 24 million. So we know that this 24 million is the lower of the two, so we'll bring it in. 24 million being the lower of the two. So to this 24 million now that will now deduct as the capital allowance. So in this case now the chargeable profit that's 2,299,275,588. So this is the E. We will now proceed to F. So F is saying that we should determine the petroleum profit tax. So the petroleum profit tax, that's 85% of the chargeable profit. That's how much? 1,954,384,250. So then we're now asked to do the G. So the G's, we're asked to calculate the company's income tax. So in this case now, company's income tax, we're told that the company earned 8.3 million from transportation of chargeable. So here's it now, the tertiary education tax. Here to be broken down into two, the petroleum operations and the non-petroleum operations. So the petroleum operation is the one we did earlier. This for 6,466,512 that we did earlier. Yeah, we now add the one for non-petroleum operation, which is 2% of this taxable profit. That's 2% of 5,950,000, which is this amount. So addition of both is the tertiary education tax. And with that, we are done with the question.